Hi guys, how's it going? I'm Sam. I'm from Canada and New Zealand, and I'm here with Bud. We're actually side by side here. Yeah, and I'm going to be asking him some questions on behalf of you guys, and we'll field some questions at the end as well, so stay tuned.
Yeah, and if you have any questions while we're talking, if there's anything confusing or you don't want to forget, just type it into the chat room. We may not get to them right away. We might do them at the end, but we'll do our best as we go through this. But we do have a lot of content to get through, so I don't know how many questions we're going to get to today.
Right on. Let's just get straight into it. Are you guys ready to go? All right. So the first question I have is, why invest?
Yeah, sure. So obviously we have our goals that we want to get to, whether it's retirement, early retirement, or fancy yachts and stuff. But there's even a simpler reason. We go through these ups and down cycles in our lifetime, and pretty much every 3 to 6 months, something unexpected comes up, and you got to pay for something. Either you get sick and you miss some work, or you get sick and actually have to pay some doctor bills. Your car gets sick, your car breaks down, your motorcycle breaks down, something in the house breaks. Everything around us is just constantly going wrong. But especially every 3 to 6 months, there's some sort of bill that I'm 37 years old now, but I was explaining this to my assistant / cleaner. She's about 23, 24 years old. And she was freaking out because her bike broke down. And I'm 37 years old, and I just go, well, that's life. That just happens. You get sort of used to these. You get used to the unexpected happening, and it becomes more expected. So you expect the unexpected, and every 3 to 6 months, something you didn't plan for goes wrong, and you have to pay money for it. So that's the number one reason why to invest. If you just save, it's great, but you're going to keep getting dings to your savings, and it's not enough to just save. We need to plan for the times that we can't work. We need to plan for the houses and the things that we're going to buy, and retirement at some point when you get to the point. Either when you just don't want to work anymore, you want to go travel, or you want to do the things that you want to do, or you can't. You can no longer work. Who's going to take care of you? We don't want to just rely on politicians to take care of us, because they can change the rules anytime they want. And even if they don't change the rules, stuff happens, right? So we want to have a nest egg, and we want that nest egg to grow. So that's the big reason why we invest. And next I want to talk about our goals. So if we talked about, yes, we want to invest. Now we know that. What should our goals be for investing? Well, my number one goal is you have to beat inflation. I don't care what your other goals are. You have to me, it's not worth investing. It's not even worth investing if you're not going to beat inflation. The governments all around the world are printing money every year. And I'm going to give this talk mostly from an American perspective, and also the American dollar, the US dollar, the USD is the reserve currency of the world. So most countries, if the US starts printing, other countries will print more to catch up to it, to maintain that import-export balance that they have to. So the first thing I want to talk about is just inflation. Inflation, of course, is the decreased purchasing power of our dollar over time. So it's kind of weird. If we had a super stable currency, the cost of things would actually go down over time, because technology makes things cheaper. Companies get more efficient. Farming gets more efficient. Everything should actually be going sort of down in price. Yet because of inflation, because we're constantly printing money, we usually see prices going up. So if you think back 20 years ago, what were the price of eggs? What were the price of milk? What was the price of gasoline? And they were much cheaper, at least for me in the US, they were much cheaper. I've also got a bit of a chip on my shoulder about inflation. The US tells us that inflation is 2% per year. But I know somewhere in the last 10 years ago, I don't remember whether it was under Bush administration or Obama or Clinton, it doesn't really matter. The inflationary index that they used for years and years, they changed the rules. When inflation was created, it included things like bread, flour, milk, eggs, and gasoline. And in the last, I should have looked this up, but in the last 10 to 15 years, they removed those things from the U.S. inflationary index. Well, this is a really big problem because we didn't stop eating eggs, we didn't stop eating bread and pizza, we didn't stop drinking milk or ice cream or yogurt. We didn't stop using any of these things, and we haven't switched from gasoline to electric. And yet, those things were removed from our inflationary index to kind of keep things calm. So I believe that our inflationary index is closer to 5% than it is to 2%. Now, what does that mean for everything? Well, A, don't trust the government is step one. But step two is I need to be investing in something that makes more than 5% a year. If it doesn't make more than 5% a year, then I know I'm automatically losing. And if I'm going to be losing on an investment, then I put it mentally, I separate savings versus investments. Okay? The point of investing is to increase in value and to gain more money and to gain more purchasing power. Okay? The point of saving is to just retain purchasing power, to save that money for future investment or future necessities. Okay? So I separate those two things. It's okay to save my money someplace that doesn't make 5% or more per year, but I don't consider that investing. I consider that saving. And when I invest, I must beat inflation. I personally count inflation at 5% because a few years ago, I tracked back what I remember the cost of eggs versus the actual cost of eggs in the store, milk, gasoline, etc. And then I did the math backwards. All right, I redid the math, and I didn't come up with 2%. I came to 5%. Now, that was about 5 or 10 years ago, and I haven't done it again since, but I imagine it's pretty close to the same thing, and we could do it again if we wanted to. But you should determine what you think inflation is, because it's also local to you. What is your inflation? There's a global inflation, but there's also your inflation. How much is your rent, gasoline, eggs, milk, whatever you eat, right? The things that you consume every month, how much are those going up? All right? So figure out what your inflationary index is for yourself, and then make sure that you choose investments that beat that.
Okay, so I just have another question. Moving
Sure.
sort of, so you're talking about beating the inflation rate, but what sort of investments are going to reliably do that?
Sure, that's a great question. And today I wanted to talk about several different types of investments and ways to grow your wealth. So let's talk about stocks. Let's talk about real estate. Let's talk about cryptocurrency. And let's talk about entrepreneurship. Because I think if you're going to be investing, you're probably considering all of these. So let's think about the pros and cons for each of these. And then let's also, afterwards, later in the segment, I want to talk about stock options specifically and how that deals with some of the cons of trading in stocks. So let's just first talk about stocks, okay? The nice thing about stocks is that there's different strategies. So when I talk about stocks, we really maybe need to break it down a bit more. But some of the pros that are possible with stocks is, number one, is time. You could trade stocks in your spare time. You don't have to be in front of the computer all the time. It doesn't have to be your primary source of income. You can work a full-time job and trade stocks. The next thing is margin or leverage. Excuse me. Most brokers these days will give you about 100% or double your money in margin. So if you put in $50,000 in cash, you can sign up for a margin account. Then you'll have $100,000 in buying power. There's some major pros and cons to margin. It's a bit more dangerous than people think it is. Okay, maybe we'll talk about that later. The next thing that's a big pro for stocks is location independence. You can especially now with computers and the internet, you can really do this anywhere. As long as you have a connection, you can even call up your broker. So even if you didn't have an internet connection, you could still make trades in your account. Okay. Another nice thing about stocks, and I want to talk about this about all these things, really, I think this is important, I should have said it first, is personality type. Stock, there's a big difference, not just in the returns and the safety and the mechanisms for all these things, but there's a big difference in the personality type for trading stocks, for doing real estate, for doing crypto, for doing especially entrepreneurship, right? Not everyone can be an entrepreneur. They really can't. And that's my personal belief. I think to be an entrepreneur, it helps if you're extroverted, it helps if you're high energy, helps if you're a fast learner, and it just doesn't fit everyone. So I want to talk about that in each of these categories. So stocks will work if you're introvert. You know, if you don't want to go out and constantly meet people and constantly be in the sales process, you can do it online on your computer without talking to another human being if you wanted to. And then another great thing about stocks is that natural appreciation. We see the market typically go up, usually 5, 10, 15-year cycles. Then we see a correction. Then we see it go up again. Repeat, repeat, repeat. So, but what are the cons? Well, it's sort of a pro and a con that everyone can be in the market, everyone can trade stocks. The con comes from the fact that it can be manipulated. People can put out false information, in fact, make money doing so. Anyway, but it's open to manipulation. People can buy up stocks to drive up the price. They can sell stocks. They can put out information to drive the price down when they're shorting the market. So it can be manipulated. Number two, another big con that I found is that there's a lot of fake strategies out there. There's a lot of people talking about stocks as if they know what they're doing, but are doing some very risky things. And it's hard to even figure out what's going on. It's hard to even tell which are the right strategies and the wrong strategies, or which strategies are right for you, I should say. Another thing, as a game designer, I care a lot about strategy, and I care a lot about just player psychology in general and people's psychology. The stock market, the stock market is full of what I call false positives, meaning you could do a trade or use a strategy and it makes money not for the reasons that you thought it did, but there's this thing in game design, when there's a random chance or a random event of something happening, psychologically players think that it was they caused it. You know, something good happened, therefore they caused it. But if something bad happens, it's not their fault. It's something external caused it. And this is the world of false positives. And the stock market is just completely full of these false positives. And the other big con to stocks is in relation to this, is it's very emotional. You can be watching the stock price go up and down every single day. And it's really easy to sell too early, to hold too long, to sell when it's going down, to get nervous and sell even though it's going through maybe even a natural cycle, or there's some news that comes out that causes you to fall, and you lose conviction in the stock because maybe you didn't do enough research in it. And so you're not just dealing with numbers, you're dealing with the psychology of having money on the table, just like you were at a poker table, right? There's a lot riding on it, and because it's so liquid, it's easy to sell early, to sell too early. Whereas real estate, for example, doesn't have that same emotional problem, because once you've bought into that piece of real estate, it's going to take time to sell. It's going to take a lot of time. You can't just make a split decision and sell unless you're calling up, a loan shark or these other quick traders. But even then, the closing time, even if you wanted to sell, right? Even if you wanted to sell right now, today, you could take a deposit and sign a contract. It's still going to take weeks or months to go through the closing process. It's just not a super liquid product. And that's part of the pro and con to real estate, is it's not liquid, but that also helps remove some of that emotional turmoil that we get with stocks. So we're already talking about real estate. Let's jump into real estate. One of the big pros to real estate is you can leverage up on real estate, right? You can put $20,000, $30,000, $40,000, $50,000 down, get a mortgage from a bank, get a nice interest rate. So you can get some really good leverage with that, better than a margin account. But it's harder. You have to get approval from the bank. You have to go through the credit process. It takes longer. Getting margin account seems to be very easy with a trading account, much, much easier than getting a full-blown mortgage from a bank. Okay. Another thing, and by the way, I'm not knocking any of these investment types.
Yeah.
These are all good investment types. Yeah.
I was just going to say, in regards to real estate, my dad, he's retired now. He's found way more success in the real estate game than he ever did in his government job in Canada.
Oh, that's great.
So it's going well for him. I hope it doesn't all come crashing down, but he seems to be always wanting to buy a new property every other week. So I don't know if that's the case, but he's finding a lot of success, whereas stocks wasn't really his thing. But I think if he knew a little bit more about options trading, he might still be in the game. So, yeah.
Sure. Yeah, you told me your father tried stocks, lost some money, and then got out of it, which definitely happens. So another really big pro to real estate is just a level of certainty that you can have. if you do it right and you take enough time, you can be very certain that, I'm going to buy this property for $70,000. I'm going to spend $20,000 in fixing it up. And then if the market stayed the same or went up, it's going to be worth $130,000. Therefore, I'm going to make profit of XYZ, right? But there's a lot of people that get into real estate that may not know those steps. And they may not, even if they do know those steps, do they really take the time to do it? Do they poke holes in the wall to check for mold? Do they go underneath all the counters and underneath the crawl space of the house to check for rusted pipes and these sort of things and broken pipes, right? But the point is, if you take the time, real estate you can have a very high certainty that you're going to make money at the other end of the transaction, okay? Another nice thing about real estate is you can sell real estate, you can have appreciation, or you can just have value increase because of a fix and flip, but you can also rent it out and get monthly cash flow. And you can combine the two, right? You could buy a property, mortgage it, you could live in it for a year, then rent it out, and then rent it out for 5 or 10 years, and then sell it. You can do all of these things with real estate. And there's some tax advantages for U.S. citizens if they set it up properly, if they do it properly with their accountant and with the proper structures, okay? But what are the cons? Well, number one, you really should be inspecting every property. And you should be looking at a lot of properties. If you really want to maximize it, what I found, and I've been to lots of seminars and I've worked with lots of real estate investors. I've done commercial property myself. I've done Airbnb. I never did single family homes for a reason. But the people that were really good and successful at this shared a similar story. They would look at 100 properties. They would make 50 to 100 offers, and then they would buy 1 or 2 of them. So that's a lot of time, number one. And number two, it's a lot of dealing with people. So you really benefit from having an extroverted personality type, which is one of the challenges that I had doing it. I'm okay with public speaking, but constantly going out and meeting new people, it takes a toll on my energy level. Another problem, and this is, to me, one of the biggest problems, or it's maybe one of the least talked about or least recognized problems. I don't know how to explain this, but in real estate, you have a big problem with tenant risk. You could be running a property for 5 or 10 years, making, by the way, real estate investors, most real estate investors that I know that were ready to buy properties from wholesalers. So a wholesaler is somebody that goes out, inspects the property, finds a good deal, negotiates with it, gets it under contract, but then sells you the contract, right? So they never take possession of the property. But they're in the process, their whole business model is finding good deals and delivering it to other investors, right? That's what a real estate wholesaler does, okay? What I noticed from the real estate wholesaler's perspective is that they could sell properties if there was a 8 to 12% ROI for the investor on a cash flow basis. In other words, to other landlords. So they go out, they find the property, they want to sell it to a landlord. What does the landlord expect before they buy? They want to see 8, 10, or 12% ROI net after all their fees. Now that sounds pretty good. And basically the 8 to 12 range not only varies by the investor, but the property location, how much is it going to appreciate, what type of tenants you're going to deal with, what is the school zone. I should say this, if you're interested in real estate in the U.S., the 3 biggest things that you should consider with determining which properties and which locations, what determines the price and value of a house, and what determines the price and value of the rent. Number 1 is job growth. Okay, you want to be buying in cities that have positive job growth, and the higher the better. Number 2, school zoning. In America, we do our schools by zoning. So your zip code and your location, your street address, determines which public school your children should go to. This plays a huge, huge role in the value of houses in those neighborhoods. Okay, and if they restructure those school zones, you want to know and go buy in the zone that's now in the good zone, and make sure that you're getting out of properties that are in the bad zone, if that happens. Okay, and number 3 is interest rate. What is the borrowing rate? How easy can people borrow money to do the mortgages? So as the federal interest rate goes up and down, that affects directly the price of houses and mortgages. Okay, so you need those 3 things to be in alignment if you're going to be long-term successful on a property. Now, if you're just buying quick fix and flip, you need to know what that is in the next 30 days. But if you're doing landlording, then you need to know what that's going to be in the next 5 or 10 years. Cool.
Awesome. All right. Thank you, Bud. Take a little sip of water. That's a lot. Guys.
Oh, I got one more thing I wanted to say. Sorry. I went on a bit of a tangent there, but I wanted to talk about how to do real estate investing properly. Mm-hmm. The next thing, though, is tenant risk. I talked about this. I started to talk about this. You could landlord a property and be cash flow positive for 1 year, 5 years, 10 years. Doesn't matter. One bad tenant can wipe out all of those profits. I'll give a real world example here. My father had a property in Utah, and he made the mistake of trying to get higher than average rent. And when you do that, you shrink the number of people that want to rent your property because your price is high. And he got a family that moved in, and at the time they had a job. He didn't do a proper background check on them, or maybe he did, but he trusted the realtor to do it for him because he wasn't local to the property. That's another problem with real estate is it's location dependent. The closer you are to your properties, the better it is. But anyway, they moved in the summer. They paid through summer and fall. As soon as the first snow fell, the guy magically lost his job, ran out of work, stopped paying. My father tried to work with him, never paid anything. My father had to pay a lawyer to take it to eviction court, and he went in front of the judge, and he blatantly said, yes, I haven't paid for X number of months. I can't find work. I'm out of work. And the judge, who's an elected official, said he's not going to throw somebody out in the middle of winter, and made my father let this family stay in the house until the snows melted, until spring came, okay? Because he's an elected official, right? When we opened up that house, they were not supposed to have pets. They never paid a pet deposit. They clearly let 2 dogs live in one room and never took it outside for walks. It was covered there was mounds of, okay, they didn't throw the diapers in the trash. They threw it in the corner of the room. There was animal feces and urine everywhere. There was holes in the wall. There was fixtures and stuff damaged. Anyway, that one tenant wiped out all the years of profit from all of that landlording for several years of having good tenants. And that's tenant risk. And this is not an uncommon story. If you meet enough real estate investors who have 10 or more properties, everyone will have this type of story. So that's a real risk that you deal with. Another thing that you deal with in real estate is management risk. If you do the math and you think about, well, what does a full-time realtor need to run an office, to pay themselves, to pay their employees, they can't just have a few houses under a landlord setup, right? If they're charged 5, 8, 10%, whatever they charge, and you multiply that out, they need about 1,000 or more properties to really run a full shop, right? To have themselves and a couple other people working there. So that just means that you're one of 1,000, right? They're also digging in. It sounds like 5% doesn't sound like much. But that's 5% of the gross. That's not 5% of your profit, right? So when you subtract 5% from the gross, it could be a major, major dent on your profit for your property. And add to that, these things happen. Something breaks in the property. They send out their maintenance guy. The maintenance guy charges $60 an hour, buys a $60 part, and then you get charged $120. And maybe that part didn't need to be fixed, or maybe that part was a used part that they took from another house. They buy it for $60, and then they return it, but they show you the receipt, and then they split the profit between each other. These things definitely happen in real estate. They happen in construction. And so there's management risk when you're not there taking care of your properties. And you can avoid that by choosing really good managers, but that's a process into itself. But let's move on. I think we talked about real estate enough.
So the next thing I wanted to say was, so we talked about real estate. We wanted to cover on a few more types of investment. Yeah. Can you just touch lightly on crypto, and then we'll dive right into stocks? Yeah, sure.
So crypto's new. There's a lot to think about with crypto because there's currencies and there's things that are, it's an empty vehicle. It's like an empty letter. It can be whatever the creators want it to be, and it can interact with tons of things in different new ways. And it is definitely the future. It's here to stay. It's not going to fade away. It hasn't gone away since 2008 or 2010 when Bitcoin was a thing. Bitcoin is surging. There's huge profits in Bitcoin if you got in lower right now. So that's the amazing thing about crypto. There's massive upside. There's probably more upside in crypto than there is in stocks. Okay. The other upside to crypto, if you want to do it, is you can trade it 24/7. But that's also the con to crypto, is it's 24/7. I personally like that stocks are only open 9 to 4 in the US, or 9:30 to 4 p.m., whatever it is. I like that there's set hours, right? And I trade stock options mostly. So I can only trade stock options during the main market. You cannot trade stock options in pre-market or aftermarket. So let's talk about the problems of crypto, right, though, is there are a lot of scams. There's a lot of scams from the original creators. There's unintentional scams, or maybe there's one bad actor in a group of programmers. So there could be what's called a backdoor exit, where they take the money and leave, okay? Another con is that it can just be confusing. There's so many cryptos out there. There's so many projects going on. And when it's that confusing, you need to spend a lot of time on it. The third problem is that it's evolving. I mean, this is a good thing, but it's also a problem. But it's a problem from an investment standpoint. How do you know the crypto that you invest in today is going to be here in 3 years, 5 years, or 10 years? It's still going to be valid. It's such a new space, and it's just programming. But it's programming. So once somebody programs something better, if there's adoption, then that thing will take over the previous thing, right? And there's massive downside risks. That's one of the biggest problems with crypto. I mentioned that there's the scams, but there's also, just like I said, something can get phased out, can get replaced by something better, and it all goes downhill. Okay? And then what I said, again, is that it's 24/7. When I was trading in crypto in 2017, there was times you stay up late because you're just watching the price, or you're thinking about the price, and then you wake up and the first thing you do before you even roll out of bed is you're checking the phone. You're looking at your phone to see what the price is, and you haven't even brushed your teeth yet. So that's the pros and cons to that. And then the last thing I want to talk about is entrepreneurship. All right, so the pros to entrepreneurship: huge upside. You can make a ton of money doing it. Another big thing with entrepreneurship is you can take on investors. It does not have to be your own money. Okay. So this is a method. This is an area where you can make a lot of money by using other people's money instead of using your own. So when you're young, this is especially great when you're young. You don't have a lot of resources, but you have a ton of energy and you have a ton of time. And the older people who have a ton of money, they don't have a ton of energy and they don't have a ton of time, so they want to invest in you, right? So entrepreneurship, I think, is really great in your early years. It's good. It's good in your early years because of time and energy. It's good in your later years because of experience. Okay. Another great thing about entrepreneurship is its self-reliance. You are the master of your own destiny. You can work as hard as you want to work. You can master it, and you can really make that business take off and be fantastic if you're willing to do it. You're not as reliant on outside forces to make you successful. Okay. But what are the cons? Number one, I really think that in most of these cases, unless it's something to do with online, you need to be extroverted. You need to be willing to talk to lots of people. You need to be able to talk to, if you're going to go big with this, you need to talk to investors. You need to talk to employees. You need to manage employees. You need to train employees. You need to deal with legal governments and all this other stuff. And so it's going to take a lot of time. Entrepreneurship is just going to take a lot of time. It's going to take all your time. And when you're doing anything with that much activity and that much on the line, it's going to create a lot of stress. And so you have to be able to deal with that level of stress. The other thing is it's low certainty. You might have a great idea and a great product, but the certainty that it's really going to work, that you're not going to get copied too soon, that you're not going to get squashed by a big competitor, it's just never there. You're always dealing with low certainty, but high risk, high reward. And the other big thing is burnout. How long can you sustain that high level of energy and that high level of work? And like I said before and touched on, though, is the laws. You have to, at some point you're going to have to deal, right? You're not just doing the thing. Like, let's say you want to make mountain bikes and you want to make really cool mountain bikes. Well, to be an entrepreneur, you don't just get to do mountain bikes. you have to make mountain bikes and deal with manufacturing and distribution and shipping and lawyers and the government and the tax authorities. You have to deal with all of it. And you think, well, why can't I just hire somebody? It's just even if you hire somebody, you still have to go through the process of identifying them, hiring them, and then still monitoring and working with them. And most of the time, they're just asking you questions and filling in the blanks. And it's so much to deal with.
Right. Let's get into the meat and potatoes of this little Zoom meeting, and let's get into stocks, but especially the options and what you do specifically in your trading.
Yeah.
So we'll start just on a general level with stocks, and then dive into options.
Gotcha. Yeah. So very quickly, I'm going to go through this, and we can make multiple videos on these topics. And if anybody wants to talk about real estate opportunities or how to do it, feel free to shoot me a message, because I've done commercial, I've done Airbnb, and I still have lots of great ideas for it, but it's not my focus right now. But I'm willing to help anybody that's going to take action, and if they've got the cash to do it. But let's talk about stocks specifically now. I think that there's some things that you need to think and consider to determine the price. What determines the price of stocks? Okay. Number one is trends. Okay. For example, electric vehicles versus gas and oil. I don't touch any gas and oil stocks right now. They could be good companies or not, but the trend is going down on gas and oil because the next 5 or 10 years, we're going to phase out gas and oil cars, and we're going to have electric vehicles. So right now, electric vehicles are trending up, solar is trending up, gas and oil is trending down. You need to be aware of the trends inside of the industry that you're going to trade in. Number two is the global economy. Okay, so I'm talking about trade deals, treaties, money printing. You need to have a general sense of where is the world going, right? Just in general. Next is your local economy. So I deal with U.S. stocks, so almost all the companies are U.S. companies, and so I should keep hyper aware of what's going on in those localities, right, in America. What is going on with the birth rate, the growth rate, stuff like this. Same thing that you would have to do with real estate. Birth rate is super important. The next thing is the interest rate. What is the Fed doing to the interest rate? Every time the Fed cuts and goes lower, we're going to see a push up in stock price because people can margin more, people can borrow more. We're talking about big hedge funds, we're talking about big investment funds. They can all invest more. That causes more buying. We typically see prices go up. Now, probably the most important two things, but you need to have like a basis. You need to have those things in your head. But then the most important two things is the company and the CEO. So let's get into that, okay? We're going to talk about two strategies today. We're going to talk about buy and pray, or buy and hold also, and we're going to talk about selling puts. And I'm going to keep this as light as possible because I don't want to get super confusing with this. Somebody who buys a call is betting that the stock will go up. Okay? And when you buy a call, you have to pay a premium. You have to choose a price that it's going to go above. It's called a strike price. And you have to choose a duration. So, for example, you think that Carnival Cruise Line is going to go to $25 or higher in the next 30 days, and you have to pay a price for that. You pay 50 cents because it's trading at $18 today or whatever, right? In order for you to make money, you have to choose a strike price lower than what you think is the target price. So you might buy the $20 call. And then once it gets to $20, every dollar becomes a dollar of profit for you. And maybe you only paid 50 cents to buy 100 shares, 50 cents times 100. So you pay $50 to get access to a one-to-one relationship once it gets above $20. Okay? So you're getting leverage because you're paying less than the stock price. You're getting leverage because you're doing a shorter time duration, but you need it to go above $20 before you start making any money. Okay? The put is just like that, but the opposite. Now you're betting that the price is going to go down. This is for the people buying puts. We're talking about people buying calls and buying puts, okay? So, again, let's use Carnival Cruise Line as an example. They're trading about $18 today. You think that it's going to drop to $10 or lower, so you buy the $15 put. You pay 50 cents per share, so you pay $50. Every dollar that it goes below $15, you make $1 times 100 shares. So you're getting massive leverage, but it has to happen in the next 30 days or whatever duration that you chose. Okay, so that is That is the basics of buying and selling puts and calls. Okay? But there's the problem. You're limited on time. You have to choose the price and direction correctly, and it needs to go there in that time. And then you're forced to sell by the end of that time. You're forced to take action. Okay? So let's flip that around. But before we do, I just want to say, if you buy a stock today, so let's say you could do two things, right? If you think that Carnival Cruise Line is going to go up in value, today it's trading at $18. You could buy 100 shares for $18 each, or you could buy a call for 50 cents times 100, so $50. So in both respects, you have this upside potential for Carnival Cruise Lines. The advantage to buying it is that you can hold it forever, for as long as it takes. It doesn't matter if it goes down. As long as it goes up, eventually you make money. Okay. The reason you do a call is to make lots more money, because you're only doing $50 per 100 shares instead of $1,800 for every 100 shares. Okay. And so I do buy and hold as well. Okay. But I do it on very few companies, and I do a ton of research on them, and I make sure that everything that can be is in alignment for those. Okay. But if I have a good, if you know a company is going to go up, instead of buying the call and instead of buying the stock, you can do what's called selling the put option. So remember, the guy who buys a put option is betting that it's going to go down. So if you sell, you're the reverse. You're selling him the option. Does that make sense?
Yeah, the best way I've heard this explained is it's kind of like you're selling him insurance. It's because if the stock goes down, they can offload their shares to you. But in our case, we don't want the stock to go down, and we're just going to collect the premium. But maybe you can expand on that.
Yeah, exactly. So here's what I love about selling puts. Okay, number one, you're collecting premium every month, which solves a problem that we had with stocks, is that there was no cash flow. The problem with stocks, the problem with the buy and hold strategy is you buy it, you hold it, and you wait for it to go up. And then when it goes up, when do you sell? Okay? You have you at least have the stress and the emotion of wanting to sell, but also like, I sold too early, it kept going up. Okay? You're stuck in that situation no matter what you do. Okay? When I sell a put, I'm getting monthly cash flow every single month. So remember, the guy bought a put for 50 cents. Well, where does that 50 cents go? It goes to me. I'm selling him the put. The second thing I love about selling puts is that I make money in three situations. If the price goes up, I make money, and I can actually close the contract sooner and increase my APR. Okay? So instead of making $50 in 30 days, I can make $49 in a week. Right? And then I can take that $49 and go reinvest it faster. And I can sell as many of these contracts as I want. So I'm not just limited to making $50. Okay? If the price stays the same, I still collect my premium when that option expires. Compare that with if you were a buy and hold investor. If you bought at 18 and in 30 days it's 18, you did nothing. You wasted 30 days and you put your money at risk for 30 days and you made nothing. Okay? The other great thing about selling the put is even if it goes down, if it doesn't go down below my strike and premium, I still collect and make money. Because in order for me to lose money, it doesn't have to go below 15, it has to go below 14.50. I get to collect the premium up front and keep that premium. So it's trading at $18 today. If it goes up, I make money, I close the contract sooner, increase my APR. If it stays the same, I collect my premium and make money. If it goes down to 16, I collect my premium and make money. If it goes down to 15, even the strike price that they chose, I collect my premium and make money. Only when it goes below 14.50 do I run the risk of losing money. But I don't lose money. I just buy 100 shares. So if you were willing to buy 100 shares of Carnival Cruise Line at 18, would you be okay with buying 100 shares at $14.50? You should be.
Yeah.
That's what I love about the put-sell strategy.
So you're using Carnival Cruise Line as an example. You obviously like this company. Can you expand on the research you've done and how you've determined this company is one that you want to trade?
Sure.
And perhaps why another company is not as good.
Sure. And for that, I'm going to share my screen with you guys. and I'm going to walk you through this. We're not going to spend 8 hours. We're just going to do what I would call like sort of your initial investigation. Let me get set up real quick. Because that's one of the things. If you're going to trade stocks, you should be doing enough research to really know about the company. But I want to show you how you could at least eliminate a company. So how to do the research and at least know whether or not to spend any more time on it. So everyone should be able to see this, and I hope everyone can zoom in and see this. Okay, so we're on one of my favorite websites. It's called wallmine.com, and you can use other websites. You can use Finance Yahoo. It doesn't matter. But what I like about this one, I move this.
Hide self.
There we go. Minimize, hide. Cool. Right. And what I love about Wallmine, though, is it's all on one page. Whereas if I do this in Yahoo Finance, I got to jump to page to page to page to get this information. So let's just pretend that I just was suddenly interested in this company. The first thing I'd want to do is I'd scroll down to the profile and read about where they're based and what they do. Okay. The very next thing I want to do is I want to go look at their balance sheet and their earnings or their income statement. Okay. The first thing I'm going to look at is the total assets and the total liabilities. Now, for those of you who already know how to do this, you could come here and look at the quick ratio and the current ratio and get a lot of the same information. But there's something I like about doing it manually, because what I'm trying to do is I'm trying to figure out the story of this company. And I want to look at the real numbers, and I want to get a good sense of everything. I don't want to just look at the quick ratio and current ratio.
Yeah, just shift it over a little bit in case they're still got this thing in the way.
Okay.
Because this is on my screen.
Thank you.
Leave it there.
Cool. So what I'm going to do is I'm going to take the total liabilities. Let's do it. Whole numbers. 315. And I'm going to take the total assets, and these are in millions, and I'm going to divide that by each other to figure out how leveraged is this company. If this number is above 0.7, that means that they've taken on over 70% of their assets in debt. And that could be in multiple rounds of debt. It could be in different types of things. It could be with investors. It could be with banks. But that's their total amount of debt that they've got, okay, short-term and long-term. If it's above 70, I usually skip it, and I go to the next company. It's not worth taking the risk because they're at a point where it's going to be harder and harder for them to borrow money. Okay. Can you go back to the regular Zoom on your screen?
I think so.
Thank you. Okay. The next thing I'm going to look at, is current liabilities to current debt. So this is what can they liquidate now, and what do they need to pay this year? And that's not looking very good right now. So notice that, I hate that little pop-up, but you notice that this is green. This doesn't mean that it's good. This just means that it went down from a previous quarter. Okay? So right now, their current liabilities is higher than their current assets. So they're a bit illiquid.
Do you want me to be on this screen?
Yeah, it's just more. I can see this screen just fine.
Mm-hmm.
Yeah. Okay, so that's not good, and that's a big ding against the company. Next, I want to look at their cash, and I compare the cash to both the current and the total. If the cash is ever higher than the total liabilities, I consider that company super. What was the word? Oh my gosh. But anyway, they've got a ton of cash. Right? They've got so much cash that they could pay off all their liabilities, so they're super funded. That's not the word. There's another word I use for this. Anyway, that would be a super positive thing, and it usually signals that they could be in the process or about to ramp up to start buying out their competitors. Okay? In this situation, we're mostly looking at, because of COVID, we're looking at cash on hand to make sure that this company can survive until the market comes back, until COVID is no longer the big threat that it is, whether it's government or actual threat, right? Until the market corrects itself. So I would come here and I'd look at the cash on hand, and I would see how much money they're also making or losing each quarter. And this company's not looking very good actually right now, because they lost here You have December 2019. They made $423 million for their shareholders. Sorry. All right. So before COVID, they were doing good. They were making $423 million a quarter. Then they were losing money. Then they lost a bunch of money. Now they're losing less money, so they're tightening their expenses. Okay, so that is good, but it's bad that they have this much cash and are losing this much money so rapidly. So this is becoming a dangerous company. So right now, I actually might not trade this anymore. I might not open a position on this for a put sell, even if the return was good. I might look for a more liquid and more positive company. The reason I liked Carnival Cruise Lines before is for the previous 5 years, they've been buying up their competitors, and they have a massive market share. And they're one of the three, if not the largest of the three, big cruise lines in the world. There's so many cruise lines that have a name, but are just subsidiaries of this company. Okay? So that was the first thing. I would just come down and I would look and figure out the story of this company in terms of what we call fundamental research. Okay? And this is the basic fundamental research, but this is what I do in the first 5 minutes to see if I even want to look at this company. And if you go back, annually before, they were making $2.5 billion, $3 billion, $3 billion a year in profits. So that's very good. The other reason I did like Carnival Cruise Line is they used to pay a dividend. Now they've stopped this, and Walmine, unless they've redone it, but in the previous quarter, I know they did not pay a dividend. But this dividend used to be $2 a share while they were trading at $40 and $50 a share. So it wasn't a very high return then. But if you were willing to buy during COVID and you expect the company to come back up to a price target of, say, 40, 45, and then redo the dividend, then you're getting a nice dividend on an $8, $10 stock. And that's actually where I bought Carnival. I was selling puts and buying Carnival when it was $8, $9, and $10. Okay?
Nice.
So right now it's trading at $17.37. I'm doing just fine on that. And
sorry. I just wanted to cut in and just say, like, the whole time, Bud's been making money off this, even though the stock's just been flat.
yeah. So you can see down here in this period, I was selling puts all in here and just collecting premium. Which is great because the more premium you collect, the lower your cost basis will be if you ever do end up owning that stock. Because when you sell a put, if the price tanks, if it goes below the distance, you can be forced to buy the shares. But you get to keep all the premium that you've collected until that event happens. Okay. Next, I'm going to show you something. I shouldn't have closed that before. That was my mistake. But I created software. I had this custom made for me, because I've used all the different major types of brokerages. I've used TD Ameritrade, Schwab, Interactive Brokers, and Tastyworks. Right now, my favorite is Tastyworks. And they've got some pretty good scanners out there, but nobody had a scanner that I wanted to do everything that I wanted it to do. So I had this custom made, and I'm going to show you how it works right now and show you how I look for stocks. So let me go back to filters real quickly. Once it gets processed. Basically, what the software does is every day, as soon as the market closes, it scans all of the stock options. And there's over 9,000 stock options. And so you go, well, geez, how do I even find anything worth trading? Well, I had this custom scanner made, so it scans all of these stock options. And then I go in here and I change my filters, and I created my presets. So this one's going to show me stocks options that are closing in 37 days or less, that are less than $100, because I have to put up the money for 100 shares. So I don't want to have anything too large in my account. And here, I created a thing called cost basis distance, CBD. No book told me anything about this. No videos that I watched told me anything about this. As far as I know, I'm sure there's some hedge funds that use this mathematic criteria that I've created, but nobody was talking about it. So I had to create this myself. And this is the cost basis distance. So when I come down here and we look at a stock, and this will tell me in the description the most important things about the stock, besides what it is. right? So this company, CVEO, is currently trading at $15.18, and I can sell the December 18th put at the $4 strike. I can collect. Well, this one, okay. Let's skip this one because I can already tell that this is probably fake. Excuse me. If the ROI is extremely high, there's a good chance that there's been a reverse split on the stock, and it hasn't been tagged as a reverse split in the system yet. That's not a problem on our side. It's a problem on the side where we get the information. Yeah. So it's actually something that we can't fix, but you can look at it and see it almost right away. Here's a better example. Okay, Kirkland's I've looked at. I haven't traded on this company, but this is one that repeatedly shows up. On Kirkland, it's currently priced at $13.43. It expires December 18th. You can sell the $10 put, so that's $3.43 below its current price. You can collect 50 cents per share in premium, so that's $50, which would be a 5% ROI in 26 days. Not in a year, just in 26 days. And if you were to repeat this every 26 days, you would net a 67% return per year. Okay, so I'm beating inflation not per year, but every single month. Okay, and here's what I want to talk about is the cost basis distance. This is my margin of safety when I make this trade. This stock needs to go down 29.26% before I start losing money. If it goes down 28% in the next 26 days, I still collect all my premium and the option expires worthless. And if this stock goes down below that price in 26 days, I just bought the stock for 30% less than somebody who bought it today. Which means that what's more likely to happen in the next month after that? Is it more likely to go up 30% so that the guy who bought today can recover, or is it more likely to go up 2% and I can cover and get back my money?
Yeah, well, obviously. 2%, yeah.
Exactly. So that's what I love about the put sell strategy and the system and the software that I've created, and I've been using this for several months now, is that if it goes up, I win. If it stays flat, I win. And if it goes down, I can still win. I can win if it doesn't go down enough. And even if it goes down, it can come back up. I can be forced to buy the shares. I didn't lose money yet. I buy shares in a company that I like if I've done the research, right? And then the stock goes up. I can make even more money than the 5% that I collected in premium. It's only when the stock goes down and stays down do I run any real risk.
Yeah, so that's how, as far as I'm aware, Bud's been making all of his money. No. I really appreciated when Bud told me about this strategy as well. I started to learn a lot. I'm not quite at a place where I can start to trade in lots of different companies at once, but it's really good to have this valuable information. I'm just being respectful of the time for people. I know some people it's getting to...
We covered a lot of information.
1 hour mark. So let's just move on to...
Let's go to the Q&A.
Yeah, Q&A. If you guys have any questions, should we go through?
Well, start typing your questions there, and then I'm going to talk about what we're offering here today. I'm in the process of building this company and forming a group of people, followers.
Do you want to share?
You can close that out. That's fine. Yeah. So would you guys like to get access to the research that I'm doing and the stocks that I'm trading as I'm trading them, as I'm doing them? All right. Because I have bigger goals. I have big goals that I need to make, right? this is going to sound crazy to some people, but I want to extend life for everyone. I want us all to live 100 extra years. And I think we're at a point where we're at the cusp of doing that, and I don't want to miss that. And I want to accelerate that as much as possible. And in order to do that, I'm having to take on bigger goals than I normally would. And so I want to grow a company where I can use my own personal money and invest and donate to these types of causes. But to do that, I need to grow a large company, make lots of money, and potentially even a hedge fund someday. So what I'm offering is for $100 a month, you'll get access to these scan results. You'll get access to the exact trades that I'm making when I'm making them. So if you want to do that, you just have to message me on Facebook and we'll take care of it. but we're in the process of building that website out, and we're going to add more features. We're going to continue to improve the scanner and improve the results that we're having.
Do you only use cash or do you use margins to buy those puts?
So we're not buying the puts. I want to be very clear on that. We're selling the puts. I know it seems weird, but a put is a contract. So the contract needs two sides. It needs the buyer and the seller. We're not the company. We're not the stock. We're the seller of the contract. So I just want to get absolutely clear on that so that you don't go make a mistake and buy puts. Okay, it's not what we're doing. Okay, so do you use cash or margin? When you sell the put, it should be all cash. Now you can put it in a margin account and it will just deduct cash from your position. But actually, Tastyworks, I can't speak to all accounts and all brokerages, but Tastyworks will discount because if it goes south, you're going to be buying the shares. So you will actually use margin in the margin account. And I do use margin. But let me point something out here. You might be, maybe the core of this question is, should you be using a margin account or a strictly cash account? I'm using margin because I'm happy with the premiums. I'm happy with my strategy. I have good conviction in the stocks. But if you use margin, you have to be careful not to use all the margin. It seems weird. They tell you have $25,000. If you put in $25,000 in cash, they'll give you $25,000 in margin. Okay? Don't use this is we should have done a disclaimer. This is not personalized, tailored financial advice. Okay, if you need that, go seek a financial advisor. We're not financial advisors. I'm talking about what I do in my account. Okay, I do not use up all the margin because the problem with margin is if you max all of it out and there's even a temporary dip, they will send you what's called a margin call. You have 24 hours to send in the money, or they will start forcibly selling stocks and they don't ask you which ones. Okay, which means that it's actually forcing you to take a loss. Because you're forced to sell, not when the stock went up, but when the stock went down, right? They're not forcing you to sell when the stock goes up. They're forcing you to sell when the stock goes down. So that's why if I have, got to rephrase this. If I have 25,000 in margin, I only want to use maybe 15, 20,000, and I leave the rest in buying power and don't use all the margin.
Cool. Thank you. We got a few more questions. Daria asks, well, what's the minimum and optimal capital requirement to start buying or selling puts?
Remember, it's selling puts, not buying. I was thinking about this a lot. You could do this. It's the price of the stock times 100. So you could do this with a $5 stock and $500. The problem I have with that is if that's all you have and you put it all into one trade, then if that one goes south, you have nothing to balance it out. I think ideally you should start, or I would start with 5,000, okay, or any amount above 5,000, okay. The more money you have opens up the number of stocks that you can choose, because if all you have is $500, you can only choose stocks that are $5 or less, which limits your pool of stocks. So I would rather see and have $5,000 in cash because that expands my pool and I can get multiple going at the same time. In case one goes bad, I still have another 9 to make up for it. By the way, I want to say this. If you go into day trading, be super careful. 90% of traders lose 90% of their portfolio in the first 90 days. And those are statistics coming from Tastyworks and the guy who made Thinkorswim. Okay? That's not me making up a number. That's coming from their research. And a lot of it has to do with this day trading stuff, because day trading is a skill. It's entrepreneurship. It takes time to master. And most people do not have the skill, the time, and just like, it's not the personality type, right? Unless you're really familiar with gambling and dealing with that level of stress, day trading is super dangerous. And I don't even consider it investing. At that point, you're buying a job and you're risking your money, and it can make a lot of money, but investing is about limiting your time, which is another great thing about the put sell strategies. You can put in the put on the weekend. It fills, it automatically goes through. It fills when the market opens, and then you wait for it to expire. You can literally do this strategy on the weekends.
Great. One more great question. How do you actually sell the puts? Are you creating an account with TD Ameritrade or something else?
Yep. So all of those big brokers I mentioned, Schwab, TD Ameritrade, which is AKA Thinkorswim, Interactive Brokers, and Tastyworks, all of them have accounts, and you just have to, when you're creating the account, you have to apply for options. And so they turn on options for you.
I'll just cut in and say, unless you're an American, you might not be able to do TD Ameritrade, but other ones are definitely available.
Yeah, IBKR is international. I mean, it's literally in the name. And that's the easiest one for international people to sign up for. The other ones have country restrictions, and I don't know what all of them are. And I don't have any affiliation with these brokers. I don't really care which one you use. If you want to use the same one that I use so that's easy to follow along with the UI UX, because I'm going to be sending out more and more videos, even when I make the trades, showing you exactly how to put it in. If you use Tastyworks, then it's really easy to follow along. And they have some of the best tools in UI for trading options.
Awesome. So just wrapping it up, guys, that's a lot of information, but I think we're definitely going to keep doing these for more and more. Like if you have specific questions, we could even do a whole video just on setting up the account and the margin and all that stuff. We could even do that if that's what you guys want. I'm really interested to hear a little bit more about what you said before about signing up for something, and then we kind of skipped over and started answering some questions. So if you can just expand on that.
Yep. So basically, what we're offering is for $100 a month, we'll give you an account on our website, which is still being finished up. But I can do these manually through email and through text while that process is being set up. And I'll share my screen real quick with you guys. So the scanner is already done. It's already working. I use the scanner every week when I'm doing my trades. I've even set it up now so that I can very easily put in reports. And then once that report is made, I'll have it sent to you guys, and you can follow along with the exact trades that I'm doing or the trades that I'm considering. And as well as I will give you guys the scan output. Now, this scanner takes a lot of bandwidth, so I can't give everyone access to go in and start using the scanner by themselves. But I can take my presets and generate an Excel file, and then you get access to the exact same scans that I'm using in case you want to do it on your own. But if you just want to follow along with the trades that I'm making, I'm literally creating reports for that and sending out emails so that you can follow, and email and video, so that you can follow along with the trade in real time.
And just to clarify, Bud, can you don't have to disclose your whole portfolio, of course, but can you just give us what your hope or not hope, but
goals?
Yeah, what are your goals for each month, for each
Sure.
for the whole year?
So I broke my goal down into two levels. Okay, my real goal is to make over 50% a year, which seems extremely high, but I'm taking as much as the market will give me. I've done the research. I'm spreading out across multiple stocks, and I think this is a very achievable goal of getting 50% ROI selling puts.
Yeah.
Okay, so I will be happy anything above 50%, and I'm content. I'm willing to be very content and still happy as long as it makes over 25%. If it's less than 25%, it's not going to meet my long-term goals. It's still good, but then I'm going to have to retune the strategy or change strategies if the market changes.
Yeah.
And you asked what it's been doing so far. So I started this strategy in account, and I made a mistake because that account did all the strategies in it, and it was hard to figure out what everything was doing. And so I moved and created a new account in Tastyworks. I put $25,000 into the account, and in 4 months, I've grown that from $25,000 to $33,000 using only this strategy. So there's no buy and hold in that account. There's no other crazy options strategies. I wanted to create an account that was just for selling puts because I really do believe that it's the simplest, safest strategy for new people to get into because it's literally, the trades that I'm making are mathematically 20 to 30, let me rephrase that, are 10 to 20% on average safer than actually buying and holding the stock.
So forgive me for doing a bit of math in my head, but that's $8,000 in 4 months.
Yes.
Which is on average $2,000 a month, and you started with $25,000. So that's I'm trying to come up with percentages. 10%.
It's less than 10%,
but per month.
Yes,
per month.
Yeah. And that's not the goal.
No,
that's not the goal. And I don't want to go out and say people are going to make 10% a month. That we get what the market gives us. Okay. My personal goal is to get 5% a month. I just happen to be beating that right now.
Yeah, brilliant. All right. So I'm not seeing any new questions, guys, but honestly, if you have any more, I think we're going to wrap up just in the next 2 minutes. So get them in real quick. But yeah, any final thoughts then while they type in the last questions?
Sure. I know we took up an entire hour already for this video, but there's so much more that we still didn't even really cover on this. I had a whole spreadsheet that talked about compounding wealth because we are reinvesting every month. And so when you make 5% a month, that's not 60% a year. That's 5% compounding monthly. And when you start compounding that both monthly and yearly, you're going to see huge returns as long as the strategy keeps working. And obviously, if the market changes, then we'll adjust our strategy or move on to new strategies. But I really think this is a great strategy that people can learn. And I invited my friends and family to this, right? I could have just been blasting this out to the general public, but I'm not that. It's because I really believe in the strategy, right? I don't really believe. When I was day trading crypto, I wasn't really promoting day trading crypto. And when I was day trading stocks, I wasn't promoting day trading stocks. The reason that I'm promoting this strategy is because I believe in the safety and the returns. Because you want to get to that inflection point. You want to get to a point where you're getting the right amount of safety and the right amount of returns. And this is really the best thing that I found, especially when you consider the time commitment to this and the location independence. This is a great way to invest anywhere in the world, continue traveling, or live wherever you want to live. And whether or not you decide to sign up today, I want you to at least know that this exists and it's out there. And you can go watch other videos. It's called the Wheel Strategy. I didn't make up the strategy. My friend Brad has been doing this for over 10 years in Florida. We met at real estate seminars. He told me about it, and I didn't really understand it or get it then. And I was so focused on real estate that I chose not to pursue it. And now, 10 years later, I'm right back to where he was. And if I've been doing that for 10 years, it would have been great because it's such a good fit for my location independence, not wanting to be super extroverted or spend a lot of time meeting tons of new people. It's a really good fit for a lot of people, and that's why I'm happy to promote it. And I feel so confident about promoting it.
So we got one more question. Do you use a platform like eToro to see what other investors are doing?
I've never used eToro. There's so many tools and so much stuff out there in the market. I want to continue exploring this, and I want to turn this into a tribe. It seems like a bit of a buzzword, but I wanted to learn from you guys, right? Somebody else gave a great quote the other day. Teaching is learning twice, right? The more we teach, the more we learn. And I want to share and trade strategies and information and tools with each other because I don't have all the tools and all the information. No one does. I have a strategy that's been working really well with the information. Part of it's just the strategy. When you're, well, really, right? If you're investing in stocks that need to go down 20% before you start losing money, that's just putting probability on your side. But, that's another thing. I want to show this before everyone goes, okay? Right here in POP, you can see this on my scanner. We talked about the cost basis distance, which I told you was the percentage distance from the price and the strike minus the premium. What I didn't tell you is that based on the implied volatility on Tastyworks and my scanner, you have the mathematical probability of profit. So I look for trades that are above 70% probability of profit, and that doesn't take into consideration the fundamental research that we do on the company and the CEO. That's just the probability of profit built in to the options and the mathematics and the implied volatility and all the other stuff that goes into calculating the price. That information is already there. So when you make the trade, you know up front, you already have just on the math and the volatility of the stock a 70% chance of winning. And then you add in the fundamental research and the premium collected and the compounding interest. It's insane.
Brilliant. I love this.
No, I don't use TikTok.
I love this one. One more. It's I think we'll wrap up with this one. It's a really good question. I think it gets into the meat and potatoes of it. How much money would one need to get started to justify the $100 a month?
Sure. So let's just do this real quick. If you did a $5,000 account and you made 5% a month, you would be generating $250 a month, right? If this doesn't work for you in the first 30 days, money back guarantee. I'll give you your money back. I don't need the money. I have the money. I want this money so that I can grow a bigger business, add more value to the business, add more value to the scanner, and I want to grow. My goal is to have a hedge fund in a couple of years, if I still want a hedge fund in 2 years. Okay, so my goal is much, much bigger than getting $100 a month from people. You know, I want to work with you to make this work. Okay. Rob Fox said that if you had $2,000, you made 5%, that would just be break even. So really, you need more than 2,000. There is the benefit of just learning, though. If you were to put in 2,000 and make $100 a month, you're at least learning. But really, you should go in with more than that.
Yeah, this is the kind of investment that most people just wish they had. They're putting money into hopefully they're putting money into their 401k or Roth IRA or something. But just to have this opportunity is crazy, and to know that it works, and like this is Bud, like him, he's not like BSing, it's real. So that's the thing.
I do want to point out, you can do this in your IRA. Right?
Cool.
You can do this in your IRA as well. We should definitely make the compounding video later, because I want to talk about what happens when you start with a fixed amount and then you're also adding money and making money every month. The returns, I did it yesterday, and the returns absolutely blew my mind. What you can get in 5 or 10 years on a small investment with small contributions monthly. Any more questions, guys? Rob Fox, any way to do this and avoid taxes? Look into a Roth. Okay, I'm not a tax advisor. I'm not a financial advisor. Ask your tax advisor. Again, U.S. based. I am doing this. I have been doing this. I switched. So I want to be absolutely clear and honest with you guys. My IRA now is pretty much all Tesla stock, because the upside to that is very high, and I'm willing to do that. So I'm not doing this in my Roth IRA. But if I wanted to do this and avoid taxes or limit taxes, I would do this in my Roth IRA. And once Tesla reaches a high enough amount, I will probably convert my Roth IRA into using this strategy. So you can use this strategy in a Roth IRA. To just explain IRAs, Roth IRAs, and 401ks. A 401k is usually provided through your employer, and it allows you to contribute a set amount, and they don't tax you on the amount going in. But what you may not know is the amount when you retire and take out is taxed. So it's not tax-free, okay? And this is the reverse. This is actually the reverse of what I would want, because if you build wealth in your retirement account and take out more money than when you were making in your job, you're going to pay more taxes in the end. So I would rather do an IRA, or what's called a Roth IRA. A Roth IRA, you're limited to your contribution. I can only contribute $6,000 a year. It used to be $5,000, but I think now it's $6,000 a year. This is for U.S. citizens. Sorry if this question doesn't apply to you. If you're international, you'll have to check with your own jurisdictions. With a Roth IRA, I can contribute $6,000, but I have already paid taxes. It comes out of my post-tax income. But when I reach a certain age, I think it's 65 or 60, I can take the money out, including the growth, tax-free. So that's why I trade, and we'll use this strategy in a Roth IRA. Great question, Rob. Thank you so much.
We all want to avoid taxes, Bud. All right, cool, guys. I think we've
used up enough of their time.
Yeah, we've used up enough of your time. You've been great to join us. Thank you so much, guys. And we've been over some final thoughts. And we will definitely do this again, though.
Yep. Yeah. You guys all have my personal contact information through Facebook or email or WhatsApp. Any questions, send them to me. We might include them in the next video. If you're interested in getting started, let me know. We'll get that set up for you guys. And if you feel like I really honestly don't have enough capital to do this, message me. We'll figure out a way to work together and get you to the point where you do have enough capital.
Great. Thank you so much, guys. And we'll see you in the next one.
Yep. Thank you, guys.